Hello, everybody. This is Ted Bauman here with our Your Money Matters video from Monday. I'm here with Clint Lee. Angela Giral, the hostess with the mostest, is on vacation. I took some stick a couple of weeks ago for being on vacation. Now it's Angela's turn. I know some of you guys are going to be disappointed, but she'll be back. Today, we want to talk about what's going on, obviously, in the markets. Let's start with just an observation. Here's a chart that shows the Russell 1000 Growth Index, which is the blue mountain, versus the Russell Value Index and Russell 2000. And I just want to show basically that value and growth have both done well at different points of the year, and then they've both stalled. Value stalled really going back at the beginning of the summer. Growth has stalled since September, and the Russell 2000, the small mid-cap universe, is all over the place. Now, today's big news is that we've had another disappointing job report. Non-farm payrolls only rose by 194,000 last month compared to the estimate of 500,000. So that's a pretty big miss. Now, the unemployment rate actually fell from 5.1% to 4.8%, indicating that we're having a labor force participation problem again. And that raises the question of whether we are at the end of an expansionary period rather than the beginning, because for a lot of this year, we've been thinking that, we're going to take off after COVID and things are going to take off. And then we have Delta and that's kind of put the kibosh on that. But maybe we're just actually at the end of a growth cycle, which means that we're at a growth we don't expect to see great earnings growth across the board, except for some companies. So question is, if we're closer to the end, what should we do? In other words, if we're closer to the end of a growth cycle and maybe headed for a pullback, maybe not a full-blown recession, what should we do? So the question is, where do we go next? But today, instead of approaching this directly, we want to talk about traps, specifically two kinds, value and growth traps. Now, a value trap is when you buy a company that appears to be undervalued, right? In other words, it's a style of investing that a lot of people get into, and there's pretty strong evidence that if you can find the right ones, you can do very well. And at certain times in the economic cycle, they outperform other types of companies, like they did first half of this year. Problem is, sometimes companies turn out to be cheap for a reason. So that's one kind of trap, a value trap. You buy companies because you think they're underpriced, but they're underpriced because they're actually not performing well. But there's another kind of trap, which is a growth trap. And that's when you buy companies on the basis that they're going to have really strong growth in the future, and that doesn't happen. And at the end of the day, you buy in at the top, and then the stock either goes sideways or it actually declines. I think we've seen a bit of that this year. Now, here's a couple of charts that show why this is important, because we want to know where we are. Historically, both traps are equally likely. Here's a chart that shows growth versus value traps. This is put together by a particular research group that wanted to show you the probability of stocks becoming those kind of traps. And back in the early 2000s, growth traps were the bigger problem, but now they're almost exactly equal. The problem is, though, and here's the second chart, that growth traps cost you a lot more money. If you overinvest in growth companies, you're likely to lose a potential annualized negative 13% if you pick the wrong companies, whereas with value traps, it's slightly lower at 9.5%. Now, the last thing I'm going to say just before we switch over to Clint is that right now, valuations are excessive, and that means that the likelihood that a growth trap could be the big issue is actually maybe the bigger one. Here's a chart that shows stocks that are trading at 10 times sales or more. That's 25% of the market right now. It's only been higher once before, and that is during the dot-com boom. Now, price to sales is critical because a lot of companies don't make profits yet, but you look at their price to sales to see where they might go. Now, the problem is that if you buy into companies that are at that high level of valuation, historically, they have underperformed the market by about 4% a year. Here's a chart that shows long-term real returns to the S&P versus the return on companies that are 10 times price to sales or more. And you can see that their return over time is about the same as the bond market. So making a mistake with growth companies, is a costly mistake. And that means that maybe it's a good time to look at value. Now, it all depends on where we are in the cycle. But the critical thing is, How do we avoid these traps, Clint? Which one is more likely at the moment? Or should we just pull all of our money out and invest in Shiba Inu crypto?
The latter. Let's just do that instead. No growth.
Yeah, I gotta get a Shiba Inu T-shirt at some point. I owe it to our
I might have to steal your idea for our next T-shirt contest.
Right.
Yeah, I mean, you were showing the chart earlier, the proportion of companies that are now trading at over 10 times sales and kind of where that is, relative to the dot-com bubble. So, when you think about what type of trap is likely going to be more common here going forward, I mean, it seems like the growth traps for sure. And there's a couple more things to support that notion. But one of them is, you talked about a growth trap being a company that fails to grow into its potential. The other aspect of that is that they do grow, but when you went into that company, you paid too high of a price, and so the excessive valuation didn't justify what those growth prospects actually were. And to that point, when you look at, there's a couple of things I'm looking at right now. One is just the relative performance of growth versus value stocks. And so here's a chart that shows going back to the last bubble, back to 2000, 2001, the relative performance of IWD, a value ETF over IWF, which is a growth ETF. So when the line's rising, value is outperforming, falling, growth is outperforming. So if you look at the left-hand side, coming out of the last tech bubble that we had, you had the surge in value performance that lasted really all the way to 2007. But since that time, it's been a complete reversal going on, 14 years now of persistent underperformance of value relative to growth. But that's starting to create some very meaningful valuation discrepancies right now in terms of those two areas. So here's a chart that shows going back about the same amount of time, the relative forward PE ratios for growth stocks compared to value stocks. You look at the zero line on here, when this line is above zero, that means growth is looking more attractive from a valuation standpoint compared to value stocks, and vice versa when the line's below zero. And the further below zero you get, the more meaningful that valuation gap is. And you can see currently right now, we're at almost a 2 standard deviation event in terms of values cheapness relative to growth. So, that's why I say that the prevalence of growth traps being out there is higher relative to value. But did you want to say something, Ted?
Yeah, I just want to jump in and just remind everybody, when we talk about growth companies, we're talking about companies that either have high growth in revenue quarter on quarter, year on year, and or companies that have high expected earnings in the future. So you can have growth companies that make decent money. And I just wanted to mention that because the biggest chunk of growth companies has been the top tech companies, right? The top mega companies. So when we talk about growth, we're not just talking about little companies, we're talking about them too. And they've performed for a reason. So I think it's important to recognize that because that raises the question of whether they have hit a temporary top. So
right. And so, all right, so we're talking about traps. I think there's two key criteria to avoiding traps, especially if you're starting to look at value stocks right now based on what we've said, or if you still have growth on your radar, this set of criteria can work to avoid traps in either space. The first criteria is to focus on quality. We've talked a lot about quality recently in these videos and in our commentaries. And there's a reason for that. It's because historically, at least, focusing on high quality companies works. And I've got the back test to the empirical research to prove that out. So here's a chart that shows a compilation of quality factors that I put together. And the way this works is that in this back test, the green line on here, for the last 10 years, if you took the Russell 3000 index and you held the top 10% of those stocks based on this quality score, the green line is your performance. If you rebalance into those top 10% of stocks on a monthly basis, the green line is the performance you experienced. If you held the bottom 10% based on quality, the red line is what you experienced on here. So you get this.
So there's a big difference. Let's just remind people what we mean by quality.
Yeah, quality can be take a number of different looks. It can be a profitability metric like a gross margin. It can be something like return on equity, return on invested capital. It could be balance sheet metrics, looking at debt to equity ratio. So quality can take a couple of different forms based on that. But generally, when it comes to profitability, balance sheet metrics, that's what we talk about when we're talking about quality. And I'll give an example of that. Actually, one of the factors within this quality umbrella that I'm including is gross profits to assets. And so here's a similar chart. It just shows if you were to hold the top 10% of companies in the Russell 3000 based on gross profits to assets. So it's basically looking at what companies do the best at using their asset base to generate profits. If you held the top 10%, you got the green line. If you held the bottom 10%, you got the red line. And this isn't to say too that you have to focus on the companies that are comprising the green line on here to avoid the value traps. What you really want to do is stay away from the companies that are on the red line. Right. That's an important distinction to make. Right. Now, so that's one criteria to use. The other criteria to use to avoid traps is relative strength. We're all familiar with the term. Don't try to catch a falling knife. And so a great example of that was the performance of GE, General Electric, back in 2016, 2017. The stock was in complete free fall. Here's a chart of what GE was doing versus the S&P 500. And I remember this just was capturing everyone's attention at the time. Friends and family asking me if it was time to buy GE yet. And you couldn't call the bottom. I mean, it just kept moving lower. So, that's why I say use relative strength and look for a turning point. You can be patient and look for a turning point before committing to a value name, especially one that's been underperforming like this. And so to give you an example of that, here's a chart of GE now going back about a year, showing its relative strength. So this line's plotting GE stock price relative to the S&P. So when the line's rising, that means it's outperforming. And that's what we've seen, since September of last year. We hit this key turning point, as I'm showing with the green channel on here. We saw this surge in performance of GE, showing that relative outperformance, getting past that catch a falling knife phase. Here this year, since about March, we've seen that line come in a little bit, but what I'm showing with the dash line and arrow on here is that it's starting to perk up again. So if GE's been on your radar, follow something like relative strength to help time when to get into those trades.
Right, which is something as simple as you've just done here, which is to divide the price of that stock, whatever company you're looking at, by the price of the index, right? And basically do that. I mean, if it's starting to rise relative to the index and it's sustainable, that's where you want to be. So where do we go with this? Well, one of the things I was thinking is that we want to look at these things from the perspective of economic cycles. And I mentioned at the beginning that we're beginning to see some rumblings that maybe we're not at the beginning of an economic growth cycle, but maybe towards the end of one, that all that growth that people were predicting post-COVID has been bunched up already, particularly in the goods sector as opposed to services. And here's a chart that shows what happens if you are getting into the end of a session or a cycle rather. It shows that if you look at quality companies, the ones we were just talking about, and then you compare them to companies that are just attractive on valuation metrics, they're cheaper than their peers, then growth underperforms quality underperforms value really during the first two parts of an economic cycle. So, which is why we saw, I think, at the beginning of 2021, that value really performed well. But then once you start getting to the point where people are starting to think, well, maybe we've peaked, maybe the economy is overheating, maybe we're getting some inflation, then that reverts, and you get a situation where quality becomes important, more important than value. So the question is that if that's where we are, that reinforces, I think, what you're saying, Clint, is that you want to be in quality companies, and that means companies that are making good money relative to their assets. So I know you have a recommendation as how to play that, Clint. How would you go looking for companies like that today, maybe in the ETF space?
Yeah, well, the good thing about the ETF space, just with all the strategies that are out there right now, there are ones that package sort of this quality value standpoint for you. So there's one I'm looking at in particular. VALQ is a ticker symbol. It's an American Century value quality ETF. So they're already coming through the universe of stocks, and they're looking at stocks that have a combination of attractive valuations along with the quality characteristics of profitability, like I was discussing earlier. So in terms of checking off that criteria, and then you can I don't have a chart of the ETF on here, but pull up a chart of the ETF, check out the relative strength, and monitor that for your entry points.
And of course, also look under the hood and see what holdings they have and how those are performing. I've got a second one I think we could look at, and this is an odd little ETF. It's not very well known. You heard it here first, folks, if you decide to check this one out. It's called SQLV. It's a Legg Mason small cap quality value ETF. Doesn't have a lot of assets under management, and it's very thinly traded, but look at its performance this year vis-a-vis the S&P 500. The chart basically just shows it's essentially more than double the performance of the S&P 500 this year. And so again, you can buy this, or you can just go and look under the hood and see what companies are in there, but that's telling you something. And I think it reinforces our message that quality is the most important thing, but if you can find value in quality, that's even better. Last chart I want to show you is the way that small cap companies, like the ones that are in that SQLV ETF, outperformed during inflationary periods. And this chart goes back to 1930s, and essentially in every decade, when you have inflationary conditions, these companies outperform the small cap quality companies outperform in inflationary periods. So if that's what you're worried about, this is a good place to be. And again, like I said, it's a thinly traded ETF, not a lot of liquidity. So you probably want to be very patient and careful with your entry and exit points, and how use a limit orders and all that. But so that's basically our message. I think we have not resolved one way or the other, but the overriding theme I think today is be careful of a growth trap. If we're likely to see any kind of mistaken investment strategies right now, it's going to be on the growth side. Just to conclude, we have another Bauman letter coming out. Actually, it'll be released today. So if you're a subscriber, you'll see it in your inboxes. We're targeting a company that's been very, very much in the news lately. And we got right ahead of that news, and we benefited from it. So we're glad to get one right. It's been a tough year for doing that, that's for sure. And don't forget, we have another big product launch coming up soon. It's another product from Clint in the option space. And this one has just blown things away. It's done incredibly well. So stay tuned for that. Until next week, this is Clint Lee and Ted Bauman signing off.